Every who down in Who Newville liked the holidays a ton, but where to get great prices on gifts they had no idea. None. They searched and they searched for great gifts under $25. Gifts for spouses and friends and even their toddlers. When suddenly one who shouted, "Walmart has what you want," knowing they have Lego, Tree Hut, and no prices to flaunt. So they enjoy the holiday season as who's often do, cheering and shouting, "Walmart has incredible gifts." Who knew? Find gifts they'll love under $25 at Walmart.
Hey, the vibes are slipping. I think it's time to bring out the Velveeta shells and cheese. The holidays are a time to go all in on indulgence. Headline your meals with the rich, creamy meltiness of Velveeta shells and cheese and satisfy your holiday cravings like no other. Bring that main course energy to your side dish. Celebrate extra with Velveeta these holidays.
Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'm going to keep talking about ROIC and important calculations that you should do in order to understand a company's corporate profitability. But as I finished my last episode giving you a formula on how to calculate ROI, today I'm going to start with another concept that is mean reversion. Economic theory and also empirical evidence are going to consistently show that ROIC is going to tend to revert towards the cost of capital over time. So that means that unusually high ROICs are likely to decline as many competitors arrive in attractive businesses. And unusually low ones are likely to also rise in a struggling business exit or consolidate. Because ROIC is going to be kind of our measure of excess returns over time. So if you're just thinking about it logically, a company can't be the only one having excess returns over time. Either more competitors will come in and its ROIC will lower, or some competitors, if the industry is not as profitable, will leave, and therefore the ROIC will rise. However, and this is a crucial nuance, the rate at which the ROIC mean reverts and the specific level to which it reverts is going to differ significantly across industries and even between companies within the same industry. So for example, defensive industries like household and personal products like, let's say, toothpaste or cleaning supplies are going to show a much higher ROIC persistence than cyclical industries like semiconductors or energy, where returns are going to swing wildly with commodity prices or technological cycles. While ROIC on average is going to revert to the mean, it's going to be important to remember one important insight, and is that good companies, which are those with persistently high ROICs, tend to remain good. And poor companies, which are those with persistently low ROICs, tend to remain poor. This isn't a contradiction to the mean reversion that we were talking about. It just means that while even the best companies might see their ROIC come down from extreme peaks, their superior moat is going to allow them to revert to a higher sustainable average ROIC that remains well above their cost of capital, unlike weaker businesses that may revert to or below the cost of capital. It is also worth noting that the asset utilization is generally more persistent than profitability margin, which will imply that changes in profitability margin are going to be more likely to drive shifts in a company's overall ROIC. So a company might maintain efficient use of its assets, but intense competition can quickly erode its pricing power and the margins. Now, if we're going into forecasting ROIC, which is also going to be a crucial part, we're going to have to forecast a company's future cash flows, including ROIC, and this is the absolute foundation of estimating intrinsic value for long-term investors. However, as I discussed previously, many investors are going to be highly susceptible to behavioral biases, because they will rely on something that's called the inside view. When you focus excessively on the unique aspects of a company, this is the inside, and their own experience, this will often lead to overly optimistic forecasts for future ROIC, assuming this incredible returns will last indefinitely. In order to mitigate this dangerous bias, you have to incorporate what's called an outside view, which is known as the reference class forecasting. And this is going to involve considering the outcomes of a relevant reference class, what happened when other similar companies were in similar situations. If you're understanding this statistical properties like the level and rate of mean reversion, the ROIC for an appropriate reference class is going to be determined by the base rate or the typical probability of a specific forecast occurring. This approach is going to help temper our specific estimates and will provide a valuable reality check that will prevent us from assuming our chosen company is completely immune and it's the absolute best. So, if I give you some tips for forecasting on what I had to do when I was taking this class at university, is that most people tend to forecast with just a growth percentage. So let's say I'm hypothetically looking at Costco, and I see that Costco has historically grown 10% every year for the last 5 years. So many investors are going to say, okay, Costco will keep growing 10% next year and maybe 9% the year after that, and maybe then like 7% consistently throughout the rest of the years. I'm making all of these numbers up just for simplicity.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Purina believes no one should have to make the impossible choice between their own safety and their pets. But nearly half of domestic abuse survivors delay leaving because they can't bring their pets with them. Through the Purple Leash Project, Purina is helping create more pet-friendly domestic violence shelters so survivors and their pets can escape and heal together. Visit Purina.com/purple to learn more.
But what we had to do is break down every element because this is oversimplifying so much. And you cannot just make up a number in your head based on historical things just in order to predict the future. So the specific company that I was analyzing was Verizon. And with Verizon, you can think of the wireless services that they're providing or also on the broadband services that they're providing. But only breaking it down into these 2 categories isn't enough. You should keep breaking it down even more. So maybe we can look at prepaid and postpaid plans. And now that you have a, let's say, tree that breaks up how each company is getting their earnings, you should try to estimate how much each of these ones will grow. So let's say in my Verizon example, we were looking into how many users they actually had. Since Verizon is only operating in the US, there's also a limit for growing the amount of users that they can potentially have. So you can't just say like, oh, they'll grow at 5% revenue every year. You have to be estimating this with numbers. So we estimated how many new users are they going to acquire, how profitable are going to be all of these users, and maybe how can they improve the profitability of each user over time. And then how much revenues each of these small branches is going to generate in order to give us an estimate of earnings. So as you can see, it's not just saying, oh, this company made 1 billion last year, so this year they're going to be making 1 million more. We can't simply put it in numbers like that. You should try to do the forecasting as detailed as you can. Because if you do this, you're going to be removing all of these biases. And so the way to do it is going to be combining this inside view, so looking into a deep research of the company, truly investigating what the company does, what its value drivers are internally, and then combining it with what competitors are doing, because we know that most of these companies are going to start acting similarly. So if I look at this internal view and I look at the external view and I start forecasting, this is going to be the correct way of doing it. And an extra method that you can use is that, of course, you might not know everything from a company, but you have Wall Street analysts that are doing this all the time as their full-time job. And all of these estimates of their growth, of their earnings, of their revenue are going to be posted online. And even if you are not paying for specific tools like Bloomberg, you could also access to most of these forecasts on Yahoo Finance. Okay? So these are going to be sources that you can consider in order to not copy, because this is what they're doing and you don't want to follow the market. You want to be doing your own analysis and knowing how much the company you think will keep earning on the years to come. A common and significant error is using a forecast horizon that is simply too short, like 5 years, because this is going to put far too much of the company's total value into a vague and unrealistic terminal value calculation, which is frequently based on economic assumptions about sustained high returns far into the future. And you will see this in many models. They'll just estimate 5 and then they'll be like, and then it will grow at 4% for the rest of eternity, which is very, very broad and ambiguous. So a more robust and economically sound approach is going to involve like an ROIC fade model, because with this model, a company's ROIC is forecast to gradually decline from its peak. So if it's currently high, it should decline to a more sustainable level, which is often its cost of capital or the industry average, over this reasonable long period, which is typically 10 to 15 years rather than just 5. And so this approach is going to explicitly reflect the empirical reality of declining returns on capital due to the competitive pressures, and then providing a much more defensible and economically sound terminal value calculation. So as you can see, understanding ROIC is not just a formula. You have to gain a very deep insight into a company's fundamental economics and its true ability to create the sustained value for shareholders. So probably your most important takeaway from this episode should be that forecasting should be extremely rigorous. And then you should consider also the decomposition into margins and turnovers, understanding that ROIC will inevitably, after many years, we're not saying like 5 years, but eventually mean reverse. And therefore, you're going to have some objective base rates that you can use in order to develop a more robust and repeatable investment process. This is going to be a very disciplined, process-oriented approach rather than just focusing solely on short-term stock price movements or over-optimistic forecast, and it's going to be the best path in order to improve an investor in consistently identifying mispriced securities. In my next episode, I'll continue talking a little bit more about the forecast, but I'll be talking now about the free cash flow, because this is another vital concept, because it's going to link directly to ROIC. I hope you liked this episode, and if you liked it, share it with someone else who wants to learn about investment, or give me a review, because this will help me tremendously to get to more people around the world. Also, stay tuned, and I'll see you next week, because I want you to keep learning more about investment and specifically value investing.